In order to revive the economy during a crisis, the government comes up with a stimulus plan. The latest was a $1.9 trillion package that were intended to overcome the efforts of the pandemic, however necessary. But have you ever thought about how it is possible to get that much money that fast? That's what we'll be diving into in today's video.
Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started.
Since 1973, when the dollar was officially decoupled from the gold standard, it has been referred to as fiat money by economists. Fiat comes from the Latin word and is sometimes translated as edict, but in essence, it signifies that money is not backed by a physical item such as gold. Almost all of the world's currencies are fiat money, and their value varies in respect to one another. Having a currency with no backing makes it easier to control the supply of money. For example, this is helpful in moments of crisis and recession. When the governments resort to measures to inject money and revive the economy, quote unquote. However, there is an upside and there are also downsides. To understand both sides of the problem, we'll have to dive into where the trillions of dollars that are a part of corona relief packages come from to afford this amount of funding. The government needs to drastically grow its indebtedness, and one way to do so is to issue government bonds or debt securities, as well as other instruments to raise money and support expenditure obligations. Bonds are basically a document in which a lender agrees to lend money to the government, but in return, the debt can be repaid at a later date with the interest, of course, depending on the country the bonds are issued in. They differ on interest rates and dates need to be repaid. In the United States case, the Treasury Department sells the issued bonds in auctions all throughout the year. Issuing bonds is a standard. In normal conditions, a market exists to absorb bonds without much difficulty, but when we're talking about trillions of dollars, things aren't so straightforward. The Fed here plays a role and they're making things a bit controversial. In theory, the Fed is self contained, with the primary goal of promoting maximum employment, stable prices, and managing long term rates in the United States. However, in exceptional circumstances such as relief packages, the Fed also serves as a buyer, purchasing the majority of government bonds. During the primary corona relief packages during Trump's presidency, the Fed showcased its willingness to buy an unlimited amount of government debt. And we all know the Fed is not allowed to buy bonds directly from the government. It needs to buy on what is also known as open market operations, being able to be purchased from so-called primary dealers like the big boys, JP Morgan, Goldman Sachs, and the others, like as soon as the Fed buys the equivalent of $1 trillion in bonds from these institutes, it injects the same amount of money into the bank. Reserves make lending easier and expanding the money supply in circulation, thus moving money into the economy that didn't exist before the Fed bought the bonds. Moreover, the Fed is no ordinary bondholder by law and has to pay its profits to the Treasury. At the end of the day, when the Treasury pays interest on the bonds, the profit earned by the bonds is returned to the government at the same time the Federal Reserve acts on open market activities. It also cuts its benchmark interest rate, basically reducing the costs. When businesses and society borrows more, it increases as well the amount of money in circulation. These are ways to stimulate the money-making loopholes in the system and unofficial ways of the endless money supply without actually printing. There is a risk to long-term stability, which might lead to currency depreciation and eventual collapse. But is the Fed overstimulating the economy with open market operations? The Fed's balance sheet, which includes assets such as bonds and liabilities, can be examined to gain a better understanding of the situation. The total amount went from $4.1 trillion in the last week of February 2020 to $7.5 trillion in the first week of February 2021. Even if these are not all government bonds, this number gives us an idea of how much the Fed has been doing during this crisis. Since the dollar is basically fiat money, that means little to no limits to issue debt as well as for the Fed to act and buy the bonds, supplying the government with more money and more dollars available. The Fed would not be able to extend the money supply to such an enormous level if the US had a currency that was backed by something. For example, if the Fed attempted to do so while on the gold standard, the dollar's value would plummet due to oversupply in comparison to its gold equivalent, jeopardizing the system's foundation for pessimists. This is putting us on a trajectory of crisis, and collapse seems inevitable. This summarizes how the cycle of collapse would work. Everything starts with a currency backed by a physical asset, gold, the precious mineral that gave value to currency and created a level of confidence that led to the expansion of commerce and credit in the case of the dollar until 1973. Was the precious mineral that gave value to currency and created a level of confidence that led to the expansion of commerce and credit. However, with a currency attached to gold, there is a limit to how much credit can be generated, because the country's currency must always be in parity with its gold reserves. This restriction led to the perception that the dollar was not benefiting from gold backing. After the country exits the system, the economy is flooded with liquidated stimulus packages, with increased expenditure in a variety of areas while also encouraging trade. As a result, abuse occurs. To meet its obligations, the government begins to spend more than it should and monetize even more of its debts. Eventually, the economic growth starts to decline in confidence. Then, inflation begins rising. The cycle begins again. Economists believe that we are at a stage where the government is starting to lose its confidence. It's tough to say, but there are no indications that the financial markets are concerned about the mounting deficit. Despite its massive debt, the US government is not financially secure. It has no trouble borrowing money, and borrowing is relatively inexpensive, with a 10-year interest rate of just over 1%. Ironically, the market interprets this as a sign that the country would be able to continue operating while in debt till the end of time. Furthermore, under the current circumstances, with predicted GDP growth of 3.7% over the next decade, any debt would tend to dissipate. For the time being, it appears that the United States' full faith and credit are sufficient for investors. It's just a matter of time.
Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.